I want to use the concept of PE ratio to discuss three major stocks that you should start stacking up right now, because they come in very cheap at this moment, and the goal is to have them for the long haul. It's not get rich quick scheme. So if you're looking for something to hold for the long term, these are the cheap stocks that you can consider to start piling up in your portfolio from now onwards. But before we discuss those stocks, let's look at the PE ratio for the stocks first. Usually I mentioned that in previous videos that PE ratio that you put into your under your radar, look for companies with, of course, reputable companies with excellent balance sheets that has PE ratio between 21 and maybe 27, 28. So those are companies that you can decide to say, okay, I'm going to hold this for a long term. I'm going to stack up on this for a long term. So I have three stocks of such right now. There is Amazon, Google, and Nvidia. Currently, Amazon is going for 21% PE ratio, or 21, not percent, 21 PE ratio. Google is approximately 18, between something and 18 PE ratio, depending on the website where you got it from. Then Nvidia is 26.5 PE ratio as of the time of recording this video. You do not need a constant stream of new ideas. All right, so you need a winner. So the most important thing is to get a winner that is sure of winning all the time and going for the long haul. So what we're trying to emphasize here is quality, durable earnings, valuation discipline. All right, so not necessarily low PE buy. So it's just about which companies they have quality shares, quality story, durable earnings, and they have valuation discipline. So those are some of the things that contribute to how you finally make a decision on which company to consider. So what exactly is PE ratio? PE ratio is just about market price in price in dollars that is paid per dollar of profit. So what that means is that if the share price of the company is $100 and their earnings per share is $5, so that means that company is within the range of 20 PE ratio. So you want to look at trailing PE, forward PE, and relative PE index. So 20 times PE ratio means investors will pay $20 for each $1 of annual earnings per share. It doesn't really necessarily mean that you will get payback in 20 years. No, it just means that it is, in terms of the price, it is cheap at that level. If it's going to 45, 50, 100 PE ratio, oh, that's expensive. So why am I emphasizing the need to consider PE ratio as one excellent buy signal? So if earnings are durable or temporarily depressed, just like Amazon, just like Google for a while now has been beaten down because they decided to go and borrow more money to fund their hyperscaling rollout. Of course, market reacts and then the prices just been crashing down like so it's just like trying to catch a falling knife. Price embeds expectations below your evidence-based forecast. So those are potential signals that shows whether to go for it. Sometimes a low PE ratio doesn't necessarily mean that it's a good stock to buy. So one-time gains could inflate earnings per share, disruption, leverage, dilution, all of this could contribute to volatility in PE ratio. So you want to pay attention to the details of the financial statement of the company. Then a PE ratio with high growth potential or company with a low PE ratio but that protects high growth potential will also be an opportunity for buy, because they might have high incremental returns and a long investment runway. For instance, a company like Nvidia, has growth potential. It's like most profitable company on earth right now. So that is a company you want to bank with respect to holding for a long term. Own it, don't trade it. And the multiple leaves room for execution error. So if the multiple values, if there are issues with execution, it might trigger a sell-off. So you just want to, so there are the pros and cons of it, but I would say do your due diligence. But for me, if I'm the one doing this, I'm going to just go all out for these trades. So Amazon and Google Q2 net income included large unrealized investment gains. Nvidia also reported equity gains. As a matter of fact, Nvidia just reported the second quarter earnings call, and an appreciable amount of gains were made. They beat their earnings, so the investment continues, and the hyperscaling rollout also continues. So use the reported PE as a screen, then rebuild earnings per share from recurring operations. So Amazon is accelerating AWS margins against capital intensive AI build out. So Amazon is continuing to raise funds to continue to invest long term into their AI growth. And of course, AWS is printing money for Amazon right now. So has accelerated growth on a large base. Advertising grew 26%. Retail margins continue improving. Currently, P ratios are approximately 21 index, and so that's far below recent multiple year averages. So that's a bull case. Now the bear case is the fact that Q2 earnings per share includes a large Anthropic related gain. So if Anthropic says we are not doing business with you again, that might be a red flag, be an issue. Free cash flow turned negative as net property investment rose. Heavy AI capex raises depreciation, execution, return on capital. So there's a pros and cons, but I'm not going to dwell so much on the bear case because these are blue chip companies, reputable companies. They are the hyperscalers. They own the data centers that powers these AI rollouts. So that is where you want to be on the long term. Of course, they are investing, so of course it might affect their cash flow in the short term, but you don't want to dwell on that into the future. What about Google? Google's search revenue grew 17%. So you see that cloud, AWS cloud, Google cloud. So cloud operating income reached $8.8 billion for Google, P ratio of 17.2%. Google is one of the most intelligently managed companies on earth. Has a $119 billion Q2 revenue. Cloud generated $24.8 billion, 34% operating margin. So Q2 earnings per share includes $6.26 per share from equity security gains, search disruption, regulation, traffic acquisition. All of this could trigger a downturn in the market value for Google, but like I said, it's a long-term plan. You want to do something you want to hold for a long term. If you trade with the winners, hold the winners for the long term. If you know how much YouTube alone is generating for Google, you will know that YouTube is printing money for Google at this moment. They have free cash flow of $53.3 billion. Q2 alone was negative after capex, but still able to manage positive free cash flow. So that is something you want to pay attention to. Then there's Nvidia. Nvidia has 19.1 forward PE, gross margin of 75%, 117% year-over-year revenue. Q2 revenue was $96 billion. So revenue more than doubled, and Q3 guidance exceeded market expectations. So all of their components, they are lucrative and most sought after in the hyperscaling industry. Ford PE falls below trailing PE as earnings expand. So from the bear case standpoint, data center generated 92% of revenue. So if there is any bottleneck around data center rollout implementation, it might affect revenue, but these guys know what they're doing. They've been doing this for a long time. Of course, they have issues with exporting to China. Of course, they are trying to become resilient against concentrating their sales in China. So they're also trying to wiggle themselves out of that quagmire. So NVIDIA is the most profitable company on earth, most bankable company. So if you're looking for blue chip companies to hold for a long term, you want to consider NVIDIA. So the ranking is not a recommendation. All right, the cheapest stock can still underperform if normalized earnings or the thesis deteriorates. So you want to pay attention to the details, especially when you read up more on their earnings call, look at their forward guidance, where are they concentrating their expenditure in the next quarter, in the next year. So some of this information can guide you into making trusted decision. So your decision tree, your decision checklist includes removing, so you checking these companies based on EPS information. You also want to check where they are concentrated, where they are investing their money. Indices for growth, so test their durability, check their upside potential, downside potential. Then price must compensate for forecast error and risk. So these are some of the indices that you want to consider when you are looking at companies with low PE ratio that you might want to invest in for the long term. So the opportunity is not cheap tech, it is disciplined ownership of quality. So hold high quality executors when normalized valuation is reasonable, while diversifying and revisiting the thesis. So this is something you want to have at the back of your mind when you are checking out other companies. Of course, there are several other companies that fall under this purview, but these are the 3 companies I would love to keep on my radar going forward. See you on the next video. And of course, please make sure you subscribe, share, like this video. We need at least 10 likes on this video. 10 likes. It will be nice. We can get 10 likes on this video. And of course, comment, tell us where you're joining us from. I will see you on the next one. Take care.